trend lines are one of the most powerful tools in trading. But the problem is, most traders are still using them completely wrong. The most confusing part about trading trend lines is that every trader seems to draw them differently. Take this chart for example. Some traders might prefer to draw the trend line connecting the wicks of the candles, while others might prefer to draw it connecting the bodies of the candles. So which one is correct? Now, even if we've figured out how to draw them, the next big question is, how do we actually trade them? Should we wait for the price to touch the trend line and enter buy, anticipating a bounce? Or should we wait for the price to break the trend line, anticipating a trend reversal to short it? The truth is, I've tried all of these approaches. But throughout my trading career, I've discovered the best way to trade trend lines, which to this day have made me a lot of profit. So in this video, I'll reveal the best strategy for trading trend lines, including an in-depth tutorial on how to actually draw them properly on your chart. And by the way, I created a free guide that compiles all the trend line strategies from this video into one document. Inside, you'll get a step-by-step blueprint on how to trade these strategies, which you can just easily follow for your next trade. To access this guide, you can grab it inside my free Telegram community. The link's in the description. Now, let's dive into the video. First, what is a trend line? A trend line is a straight line drawn on a chart that connects two or more swing points in price. Let's look at an example. In this chart, we can see that price is fluctuating, moving up and down repeatedly. So, with all these movements happening, how can we tell where the market is actually heading? Simple, we draw a trend line. By drawing a straight line connecting the swing lows on the chart, we can see that the trend line is heading in an upward slope. This tells us that despite these short-term fluctuations in price, the overall market trend is up. Now let's look at the opposite scenario. Here's another chart. Again, we can see that price is fluctuating, moving both up and down. However, when we apply a trend line, this time connecting the swing highs, we can see that the trend line is sloping downwards, meaning that despite the short-term fluctuations, the overall market trend is down. Now, a question you might be asking is, can't we already tell where the overall market is heading just by looking at it? Why do we even need trend lines? The answer is simple. Trend lines do more than just show the trend. They also help us spot trade setups that we otherwise wouldn't have spotted if we looked at the charts with the naked eye. For example, in this chart, we've applied a trend line by connecting the swing lows. Now, notice that in the past, price tends to bounce off the trend line every time it touches it. This tells us that in the future, if price ever approaches the trend line again, there's a high probability that we can expect another bounce. So, a possible trade setup here would be to take a buy trade if price retraces to the trend line. Now, the second reason why trend lines are useful is that if price breaks a trend line, it could signal a possible change in trend direction. For example, in this chart, we've applied a trend line by connecting the swing highs, and it clearly shows that the market is in the downtrend. But right here, price broke above the trend line, and soon after, the trend shifts from a downtrend to an uptrend. Knowing this, the next time price breaks out of a trend line during the downtrend, we could set up a possible buy trade. But keep in mind, the examples I showed you are just ideal scenarios. In real trading, we can't just blindly enter a trade every time price touches or breaks a trend line, because these patterns rarely work by themselves. We need to combine other concepts, such as price action, to increase our chances of getting successful trades, which we'll get into later in the video. Now, before we start trading with trend lines, we first need to know how to actually draw them properly, because if you get this wrong, the strategies won't work anyway. So, here's an in-depth guide on how I draw trend lines. To draw a trend line, we first need to identify something called swing points in the price. A swing point is when price moves into an area and then moves away from it. For example, here we can see that price went down and then reverses back up. Now, this lowest point before the price moves away is called a swing low. Our job is to find as many of these swing points as possible on the chart. And in this case, we can see multiple swing lows right here. However, the key here is to only mark the swing points that are major and obvious to spot. So, only mark the ones that stand out. Now, there needs to be at least 2 major swing points in order for us to be able to draw a trend line. In this case, we have more than enough. So, once you identified them, Simply draw a straight line connecting them. So that's going to be your trend line. Now, a common question people ask when drawing a trend line is, should I draw them touching the wicks of the candles? Or should I draw them touching the bodies of the candles? The answer is, whichever gets you the most touch points. For example, looking at this chart, if we draw a trend line by touching the wicks, we get a total of 3 touch points. However, if we draw it touching the candle bodies, we get a total of 5 touch points. So for this specific chart, since the goal is to get as many touch points as possible, we'll draw it touching the bodies. Now, an important thing to keep in mind is that trend lines should be treated like areas or zones instead of fixed lines. So when drawing them, as long as the trend line is still within the general area of the swing points, the trend line is still valid. It doesn't matter if you draw it slightly higher like this or slightly lower like this. As long as it's still within that area, the trend line is still valid, so don't overthink it too much. Now, if we look at the price action on top, we can also see multiple major swing points. So, let's try drawing a trend line. If we draw it like this, notice that some swing points overlap the trend line, meaning this isn't the right way to do it. But if we draw it like this instead, notice that the swing points are now touching properly, so this is how I'll draw the trend line. Let's look at another example to make this even clearer. Again, the first step is to identify major swing points, and here we can immediately see multiple obvious swing points. We have multiple swing highs here and multiple swing lows here. Next, we simply draw the trend line by connecting these swing points. So, this will be our trend line. To recap, the key to drawing trend lines is simply identifying major swing points and connecting them to get as many touch points as possible. And don't worry if you don't get it right the first time, because the more you practice drawing them yourself, the easier it will get. Alright, now that you know how to draw trend lines the right way, I'm going to reveal the high win rate strategy that I use. So, the way this strategy works is we treat trend lines as key levels. Let's say you have an existing trend line drawn on a chart. Now, when drawing a trend line, we can see that price has bounced from it every time it touches in the past. So in the future, we could possibly expect another bounce. However, that doesn't mean we can just enter buy every time price touches the trend line, because this pattern won't always work. Like in this example. Here, you can see that price has rejected the trend line in the past, and now it can be seen touching it again, so you might expect another bounce. However, instead of bouncing, price instead breaks right through. So if you blindly bought at this trend line, you would have taken a loss. And that's exactly why you need a better approach. So, here's the strategy I use that's made me a lot of money. The first step is to spot a valid trend line setup. Like in this chart, we can see that price is on an uptrend, and we also have swing lows here that we can connect. So we can just draw a trend line right here. Now, since the market is in an uptrend, we expect the price to bounce off upwards. So the only trend line that we need to draw is this one below. Next, I use an indicator called the stochastic. To apply it, go to the indicator section on your charting platform, type in stochastic, click this one to apply it on your chart. Once it's applied, we need to change the settings to the custom settings I normally use. So, go to its settings and just copy these values. This will help the indicator give better signals. Now that all the tools are set, we can start looking for entries. So, what I look for is price approaching the trend line, but I also want to make sure that the blue stochastic line crosses into the oversold level, which is this bottom level here. So that would look something like this. But keep in mind, as I mentioned earlier, we treat trend lines as zones instead of fixed lines. This means that price doesn't have to touch the trend line perfectly. As long as it's within the zone of the trend line, while the stochastic crossed oversold, the setup is still valid. For our last entry confirmation, wait for the stochastic line to cross back inside the oversold levels again. So, to recap, first we want to see price approaching the trend line area. Next, we want to see the stochastic crosses into oversold, then crosses back inside again. Once these signals are met, I open a buy position. For the risk management, we set our stop loss slightly below the swing low in this area. And for take profit, we target 2 times the size of our stop loss. And as you can see, price bounced, hitting our take profit. So the key to this strategy is simply using stochastic as extra confirmation for our trade, so that we don't blindly enter trades when price touches the trend line. Let's look at another example. In this chart, we already have our stochastic with the custom settings applied. Next, we can see an obvious trend line that we can draw at these swing highs, so just draw it right there. Now, since the overall trend is heading down, the setup we're looking for is price bouncing off this trend line to the downside. That's why we only draw the trend line above and didn't need to draw the one below. Next, we wait for price to approach the trend line while the stochastic crosses the overbought line. Now in this example, notice that the price didn't touch the trend line perfectly and instead slightly broke above it. However, this still counts as a valid setup because it's still within the trend line zone. Now, an interesting thing about this specific setup is that this area where price touches the trend line also seems to align with a support turned resistance level here. This is called confluence, and usually it's a sign that price has a higher chance of bouncing off that key level because of the two key levels converging. For the final entry confirmation, we wait for the stochastic line to cross back inside the overbought level. Once that happens, we take a short position. Next, we can place a stop loss slightly above the swing high, and the take profit at 2 times the size of our stop loss. And as you can see, price dropped perfectly and hits our take profit. Now, there's actually another trend line strategy that I use, and this one can potentially bring in even more profits. So let's move on to strategy number 2. The way this strategy works is simple. Let's say we have an established trend line during a downtrend. Normally, if price breaks out of a trend line, it signals a trend change to an uptrend, because a trend line break tells us that the existing downtrend structure has been broken. However, you can't just blindly enter positions when a trend line breaks, because price could form what's called a false breakout. This is when price breaks a trend line, making you think a trend change is happening, but it reverses back down instead. If you entered a buy position, you'll end up taking a loss. Now, there's actually a way to avoid this. So here's the trend line breakout strategy I use that's made me a lot of money. The first step of this strategy is to find an existing trend line. And in this chart, we can see that price is in a downtrend, and we have swing points right here that we can connect to draw a trend line. Next, we wait for price to break out of that trend line. Now, in order to know whether this breakout is likely a real breakout or a false breakout, we need to look for signs that the downtrend is getting weaker, and the way I do that is by analyzing market structure. Here's how it works. In this example, price makes a low, then it breaks that low, forming what's called a lower low. Shortly after, it happens again. Price breaks the previous low, forming another lower low. And then once more, price breaks the low and forms yet another lower low. This shows that price keeps forming lower lows, which tells us the downtrend is still strong. But now, look at what happens before the breakout. We notice that price fails to form another lower low and instead forms higher low. This tells us that this downtrend structure was already getting weaker before the price broke out. Another key confirmation is making sure that when price broke out, the candle should close well above the trend line. Because again, we treat trend lines as zones, so we want to see a strong close above the trend line to confirm that price has actually shifted into an uptrend. So this is what I look for before entering a trade. Now, it's important that we find higher lows that's also followed by a trend line breakout, because in this example, we see multiple higher lows earlier, but since they were not followed by a trend line breakout, they were not valid entry points. So to recap, first, we want to see the existing trend getting weaker. In this case, price shifts from lower low structure to a higher low structure. Next, we wait for price to break out and close well above the trend line. Once these signals are confirmed, we take a buy position. For stop loss, place it slightly below the trend line break and set a take profit at 2 times the stop loss size. And as you can see, price went up and hits our take profit target. Now, let's look at another example. Again, the first step is finding an established trend line. In this case, it's an uptrend, meaning we're looking for a trend change to a downtrend. Next, we identify momentum loss by looking at the market structure. And here we can see that price shifted from making higher highs to lower highs, signaling that this existing uptrend is getting weaker. Once this happens, we wait for the price to close well below the trend line, confirming the trend change. And because this is a bearish setup, we take a short position. Next, a stop loss could be placed slightly above the trend line break, and a take profit at 2 times the stop loss size. And as you can see, price went down and hits our take profit. Now, if you watched the tutorial this far, I assume you're one of the few people who are actually serious about learning how to trade. So if you got value from this video and want to learn even more, I've put together a free guide that compiles all the trendline strategies from this video into one document. Inside, you'll find a step-by-step guide exactly how to identify and trade trend lines. You can use this guide as reference whenever you're trading next. If you want access to it, you can grab it inside my free Telegram community, linked in the description.